Investing in IPOs has its own charm, and you know the reason. You get an opportunity to make bumper gains in a very short period. In fact, in FY24, the top 5 IPOs by listing day gains delivered between 88 and 171%. But no one can be that lucky, right? Well, good IPOs generate so much interest that are oversubscribed to a level that only a few small fraction of investors get allotments. The good news is even after listing, newly listed companies can continue to do well. In FY24, the top 5 IPOs by total gains returned between 172 and 325% when their listing day gains were between 19 and 88%. It's this return potential of IPOs that makes them hot and attracts investors towards them. But to profit from IPOs, you need to know how to pick the best ones from the crowd. And to do that, you must know how to analyze them. Hello and welcome to ET Money's YouTube channel. Today, we are going to talk about how to pick winning IPOs. And throughout the video, I'll keep sharing with you IPO investing hacks that can significantly improve your outcome from IPO investing. So don't miss any part of this video. But before we begin, a quick reminder. You're watching this video on our English channel. हमारा एक हिंदी चैनल भी है जहाँ पे ये सारी वीडियोस आप हिंदी में देख सकते हैं. And if you are or know someone who wants to understand the basics of finance in a quick and easy way, we have a channel called as 5-Minute Finance. I'm including their link in the description. So let's dive deeper into the world of IPO investing now. As promised, let me start with an IPO hack. As I said, I will keep sprinkling such hacks throughout the video, so do ensure that you watch it completely. So here it is. Avoid investing in any and every IPO just because the IPO market is hot and sizzling at the moment. In the quest for listing gains, many investors blindly bet on IPOs, specifically during bull runs. This is often a mistake. And here is why. In poor IPOs that see not so much interest, you are sure to get allotment. But in good IPOs, there is always an oversubscription, and hence your chances of getting an allotment are dependent on luck. So your chances of losing money in poor IPOs can be higher than your chances of making money in good IPOs. Here is an example. In FY24, regardless of whether they were good or bad, quite a lot of IPOs lost money on the listing day. The listing day losses of the worst 5 IPOs range from 9 to 11%. So don't throw darts on IPOs in the dark. Rather, analyze them properly so that you can hold on to the stock even if it falls on listing. And this brings us back to our theme of analyzing IPOs. But what's so special about IPOs that they require special analysis? After all, it is a company, and why can't it be analyzed just like any other listed company? Well, in many respects, there are overlaps between the way listed companies are analyzed and the way IPOs are analyzed. But there is one key difference too. There is often significant information available in the public domain about listed companies. But because an IPO company is new, there is limited information available about it. So, apart from traditional analytical measures, a few other things are also to be checked in case of IPOs. That's why we've prepared a framework especially for analyzing IPOs. This framework has 3 legs. Number 1, traditional analytical measures. Number 2, IPO-specific analytical measures. And number 3, valuations. Now let's discuss each of them in greater detail. Okay, so when it comes to analyzing IPOs, 3 documents are often cited. Number 1, DRHP or Draft Red Herring Prospectus. Number 2, RHP or Red Herring Prospectus. And number 3, Final Offer Document. You can find these on the SEBI website under the Filings tab. These are also available on stock exchange websites. But what's the difference between these 3 documents? Well, these 3 documents are nothing but the evolved version of one another. The DRHP is the draft proposal which is reviewed by the regulator and exchanges. After approval of the IPO application, the RHP is filed. It includes changes in the DRHP as required by the SEBI or exchanges and updated information about the company. Lastly, the final offer document is filed, which has all the information in the RHP plus the information about the issue size, number of shares, and issue prices. It is often filed after an issue has closed. Now, for all practical purposes, the most important document among these is the RHP. That's because it has all the information about the company except the pricing information. Now, the RHP has a standard format, so it's easy to locate information in it irrespective of the type of company that has filed it. Now, the table of contents sections of the RHP is linked to specific sections. so you can directly jump to the relevant sections from the table of contents. Now, since RHP is a detailed document, it can run into several hundred pages. While that can be good for you if you have time available to read through it, as you get a comprehensive picture of the company and the industry it operates in. But most investors don't have that much time. That's why let's see some sections of the RHP that you should pay attention to. First is the summary of the offer document. It is a convenient way to know about the broad details of the company and the offer. Second is risk factors. Now there could be numerous risk factors listed, but one must pay attention to the most relevant ones and skip the ones that are there just for the sake of comprehensiveness or formality. For instance, in its RHP, EPAC Durable noted that a significant portion of its revenue originates from certain key customers and hence a loss of any such customer can be adverse for its business. Well, that's not the only risk factor that EPAC noted. There were as many as 84 internal and external risk factors, but many of them are too general. Third is the About the Company section. This section can tell you all you need to know about the company's business or the industry. It also has information on the management and promoters. For instance, in its RHP, Juniper Hotels stated that it is a luxury hotel development and ownership company. It is the largest owner of Hyatt affiliated hotels in India by the number of keys. Its promoters are Arun Kumar Sharaf, Sharaf Hotels, 2Cs Holidays and Juniper Investments. Fourth is financial information. This section includes balance sheets, income statements and cash flow statements of the last couple of years. You can use these statements to run the required calculations. For instance, you can calculate the profit and revenue growth. You can check the operational cash flows are sound. You can also check the debt position of the company. Take the case of Gopal Snacks. In the last 3 financial years, Gopal Snacks reported a flattish revenue growth, but its profit growth has been robust. The fifth component is the legal information, and we'll talk about it in the next section. So, these are some of the major sections of the RHP. As I said, there is a lot more information than this, and hence a major challenge for you as an IPO investor is to navigate through it. Now, one key piece of information that the RHP is missing is the pricing details. So, you don't get to know at what price the shares are being offered. You also don't get to know the number of shares that are up for offer. However, indicative upper limits are mentioned in the RHP. For instance, in its RHP, JB Chemicals targeted a fresh issue of up to 165 crores and an offer for sale of up to 39 lakh shares. Now, in the absence of price information, one cannot find out the number of shares being offered in the fresh issue and the aggregate value of the shares to be sold through the OFS route. We will talk about fresh issues and offers for sale in the next section. Well, it's time for another IPO investing hack. So, how can you increase your chances of getting an IPO allotment? You can do 3 things for that. First, always apply at the cutoff price. You can select this option at the time of making an IPO application. Often, IPOs have a price band. You should not fall into the temptation of applying for the IPO at the lowest price. If you do so, you will never get the allotment in good IPOs. So, always go for the cutoff price. Secondly, apply for the IPO from multiple accounts. Do know that all these accounts must be linked with different PANs. If you apply for an IPO through multiple demat accounts that are linked to the same PAN number, your IPO application will get rejected. So please be mindful of that. From one PAN number, there must be just one application. Third, some IPOs also have the shareholder or the employee quota. If these apply to you, you can benefit from them. For instance, in HDFC AMC's IPO, there was a special quota for HDFC shareholders. And in the Tata Technologies IPO, there was a quota for Tata Motor shareholders. Alright, let's now talk about some IPO-specific analytical measures. So we saw that the IPO companies can be analyzed just like any other company, and the RHP plays an important role in that. But there are some practical considerations you should be mindful of as well as while analyzing IPOs. One important thing, while I discuss these considerations, I will also quote real-life examples of some IPOs. The intention is not to flag a problem with them, but to just highlight a fact. Alright, the first thing to know is whether it's a fresh issue or an offer for sale or both. Let me explain this for you. A fresh issue is where the money raised from the IPO goes to the company. An offer for sale or an OFS is when the money raised doesn't go to the company. Rather, it goes to the promoters or the shareholders who are selling their stake in the OFS. Now, generally speaking, if an IPO entails just OFS, it may be avoidable. That's because the company is not going to benefit from the IPO. Now, there is another way to think about it. The promoter or certain shareholders are selling part of their stake. And if someone is selling, there must be a strong reason for that, right? For instance, the promoter may need the money for another of his businesses, or he may need it for personal reason. For instance, the IPO of Gopal Snacks, which came in March 2024, was entirely an OFS. The company raised 650 crores through the IPO. In the objects of the offer, the company stated that the IPO is meant to carry out OFS and achieve the benefits of listing of equity shares. Many PSUs can come up with an OFS too. That's not necessarily bad, as the government is required by regulation to bring down its stakes in PSUs to the mandated 75% or less. Now, if an IPO entails both fresh issue and OFS, check the size of both and figure out who is selling the stake in the OFS. If possible, try to find out the reason for the stake sale. Now, if it's a small stake sale on the part of promoters, that may not be bad, as promoters may be just seeking some return on their investment. OFS is also a way to provide an exit route to venture capitalists and private equity investors. So it's perfectly fine if an OFS is meant to provide them an exit route. Now, if this is not an OFS, you should specifically check how the IPO proceeds are expected to be used. That's the second thing. Now, if a company is raising capital for expansion or growth, then that's a good thing. But if it's raising capital under pressure, that's a potential red flag. For instance, a company may be raising funds to pay off its debt. This may signal distress. Even money raised for an unrelated, irrelevant acquisition should raise eyebrows. Now, another instance where you should look closely at the business model is when the money is being raised to meet working capital requirements. For instance, in January 2024, Jyoti CNC Automation came with an IPO of 1000 crore. It was a fully fresh issue. In its RHP, the company said that it plans to use the proceeds to repay borrowings and fund long-term working capital requirements. It also mentioned general corporate purposes and another reason for raising capital. All in all, in fresh issues, do look for why money is being raised. You can find this information in the RHP. The third thing you should specifically check is if the company has issued shares in the recent past, and if it has, at what price. Now, this information is available under the summary of the issue document or under capital structure. If the IPO price is at a significant premium to the recent issue price, that's almost unacceptable unless there is a strong reason as to why the price should be higher now. To ride bull runs, IPOs are often overpriced by investment bankers. By looking at the last issue price, you can put things in perspective. For instance, in its RHP, Moti Sons Dweller said that it has not issued any equity or preference shares in the last 1 year at a price which may be lower than the issue price. The fourth thing that must be checked is what I mentioned briefly a short while ago: legal information in the RHP. Now, this section details the ongoing litigations against the company and promoters. You need to see two things here. One, how many there are, and number two, how serious they look. A number of litigations indicate innate problems with the company. They could also highlight brewing corporate governance issues. For instance, in its RHP, Muka Proteins mentioned 4 litigations going on against it. Of these, there was one involving tax liabilities of 4.35 crores. Compare this with Muka's FY23 net profit of 47.5 crore. So, these were the few IPO-specific analytical things you must check. And with this, it's time for another IPO hack. So here you go. Are there any signs that indicate an IPO will list at a premium? And we are not talking about the grey market premium here, as it often changes abruptly. Okay, this is not to say that you should not analyze an IPO. Nothing can replace analysis. But that said, there can be some cues indeed. First, keep an eye on the oversubscription ratio. The higher it is, the better the chances that an IPO lists at a premium. So avoid applying for the IPO on the very first day. An IPO remains open for 3 days and you can apply for it on the 3rd day, so you get to know the sentiment. For an allotment perspective, it doesn't matter whether you apply on the first or the last day. Second, look for the uniqueness in the IPO. If there are many listed peers of the IPO company, there are many options to invest already. So the IPO may not be a bumper listing. On the other hand, if it's a unique company to list, chances are there will be demand for its shares both pre and post listing. Third, look at the issue size. If the size is small and the oversubscription is high, chances are there is high demand for the company's share. If the issue is large that can accommodate most investors, there may not be large jump on listing. Unfortunately, a small issue size also means your chances of getting an allotment are even weaker in case of oversubscription. Fourth, look at the short-term market mood. If bulls are rampaging through the street, there is a healthy chance for the IPO to list at a gain. But if bears are on the prowl, even a good IPO may see a tepid listing. Fifth, if an IPO has lower valuation than its peers without any business deficiencies, it may list at a premium to catch up with its listed peers. Well, you may think that you're required to know the valuations for this, and you are right. That's our next topic as well, and the third and final leg of IPO analysis. IPO valuations are perhaps the trickiest part of IPO analysis, and that's because you don't get to know the price until the IPO actually hits the market. And as we discussed, the RHP doesn't have the pricing information. So you can assess valuations only when the price is known. But once you know the price, or rather the price band, how can you calculate valuations? Now for the ease of explanation, I'll use an example here to explain how you can calculate valuations. But I will also mention where you can find the required components in the RHP. Let's say a certain company A is coming with an IPO. It has decided that the price band as 950 to 1000 rupees per share. Its existing number of shares is 90 lakh. Through a fresh issue, it aims to issue another 10 lakh shares. So its post-issue share count will be 1 crore. Now, IPOs can also have an OFS component, but because existing shareholders sell their own stake through the OFS share count doesn't impact the calculation of valuations. So you need to consider just the fresh issue of shares in valuation calculations. In the RHP, you can find the existing number of shares in the capital structure section. The number of shares offered in the fresh issue will be available when the IPO hits the street. You can just Google the IPO details or check the IPO ad published in most business newspapers or visit stock exchange websites. Let's now discuss how you can calculate two commonly used valuation metrics, PE and PB. Now PE stands for price to earnings ratio. It is calculated by dividing the stock price by earnings per share or EPS. The lower the PE, the cheaper the stock. But to make better sense of it, it's better to compare it with industry peers or historical median. Okay, to calculate the PE, you need the price and the EPS. The price is there in the IPO price band. But how do you find the EPS? Now, the EPS that you find in the financial details section of the RHP is for the existing number of shares. It doesn't include the fresh shares to be issued. So, to find the updated EPS, you will need the net profit figure and divide it by the updated number of shares. You can find the net profits from the financial information section of the RHP. Now let's say the company in our example has a profit of 100 crores in FY23, and as we saw that its post-issue number of shares is 1 crore. So its EPS will be 100. Now the price band is 950 to 1000. Let's consider the upper price band of 1000. That gives us the PE of 10. So the P comes out to be 10 at the upper price band. At this price, the company's market capitalization or market size will be 1000 crores. Now, you can compare the PE with the PEs of industry peers to get an idea of how expensive the stock is in relative terms. So if its peers are trading at a median PE of let's say 20, the stock is quite cheaper. On the other hand, if the peers have a median of say 8, then the stock is comparatively more expensive. You can find the details of the industry peers in the RHP too. Of course, valuation shouldn't be seen in isolation. They should be assessed in conjunction with the overall strength of the underlying business, management competence, growth potential, and so on. Next comes PB. PB stands for price to book ratio. It is derived by dividing the stock price by book value per share. Now, you can find the book value from the balance sheet. By dividing it by the number of shares, you can get the book value per share. Let's say the book value is 500 crores in our example. So the book value will be 500 rupees per share. At the upper price band, the PB will be 2. As is the case with PE, the lower the PB, the cheaper the stock. But to put it in context, you either need the historical average or the PB of the peers. One more thing, PB is more relevant as a valuation measure for finance and asset-heavy companies. It's not very relevant for asset-light companies. So, this is how you can assess valuations. There are other valuations measures as well, such as the PEG ratio, price to cash flow ratio, price to sales ratio, and so on. If you would like to dive deeper into valuations, you can study what these valuation ratios entail and then pick the relevant numbers from the RHP and calculate them. Now, I understand that many of us don't want to do these tricky calculations. So an easy way to is go to financial websites. They often mention the valuation figures after doing the background calculations. But that said, you shouldn't rely solely on the viewpoints of these websites. To make any investment, whether it's an IPO or a stock or a fund, you must do your own due diligence. Consider all material available as just tools and not as actionable advice. And this brings us to another IPO hack. Can there be a shortcut to know if an IPO is overvalued or undervalued? Well, to be sure, in investing there are no shortcuts. Shortcuts can actually prove to be quite costly. Yet, there is at least one indicator. Do know that I use the word indicator, so don't use it in isolation and don't rely too much on this shortcut. So, here it is. IPOs are going to be overvalued in most cases, and that's because the promoters will like to get as much as they can when they list their companies. But if it's a forced IPO where the company had to list due to some regulatory requirement, the IPO may not be steeply priced. Many banks or small finance banks may have such regulatory requirements. That's because the company's goal is to list and not to garner as much money as it can. Also, PSU IPOs are often not steeply priced. That's because the government doesn't want to be seen swindling out retail investors. And many PSUs also have government stake of far above the mandated 75%. To bring it down to the mandated requirement, you may find PSU OFS being launched. Such OFS also don't price shares steeply as the main goal is compliance rather than maximizing gains. But is there a mutual fund that invests in IPOs and can save all the effort required in analyzing and picking IPOs? Yes, there is one. Edelweiss recently listed IPO fund. This fund invests in recently listed companies and helps you profit from their potential without having to pick IPOs yourself. So, if you're a hands-off investor, you can take a look at this fund. But again, do your own due diligence. Don't forget that you can invest in any mutual fund or annuity money without paying commissions. And that was the last hack for this video. And that's all I have for you in this video. I hope you found this video useful. And if you did, do share it with your friends and family. I'll see you with another video soon. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.